Hello, everyone. Thank you for being here. Welcome, welcome, welcome. We are so thrilled to have you. And this book's coming out in about a month. You will see it. We're still working on the proof. Love that. And then we have the wonderful William H. Steiner here today. And he and I have just been talking about when you have your money invested or you have money to invest, you need to make sure that you have worked with someone like us, our company, who has the investment risk advisor mastermind, which instructs you and gets you through building a team so that you can start investing and not outlive your money and stay ahead of inflation. Those are the two biggest things that you need to do with your money. Stay ahead of inflation, number one, and never outlive your money.
Yep.
So we're thrilled to have William with us today because he's going to talk to you about how you can do both of those things in one stroke. So
Right.
let me tell you a little bit about William. He's the owner and founder of W.H. Steiner, specializing in teaching how to build wealth tax-free, which is another thing that stays ahead of inflation, with the power of interrupted compound interest while avoiding the volatility of the market safely in the insurance industry. Insurance has evolved over time. 702 Plans provides how to achieve cash accumulation using the IRS code 7702. Create unprecedented levels of wealth by learning more about the 702 plan, which you'll learn today. Through his services, William helps individuals learn risk-free techniques that can lead to generational wealth creation for their families and communities alike. William is dedicated to providing this education so our community remains strong for future generations. Every week, they discuss a different subject and provide tips. As experts, they will answer your challenges and questions regarding finance and real estate. And what questions do you have about investing as a passive partner? It's very important to get those answers. Have a deal that needs a independent party to look at? Well, William does that as well as I do that. And we are here to assist you, whether it be William or whether it be the nest egg builder, for you
Yep.
reaching your financial goals. So I am so happy to have William here. He's been here several times. And yay, William, thank you for being here again. You're so smart. It's really important to us to have people be financially free. And
Sure.
the more people who can really understand what's going on and support them, the better it is. And this is why Christina and Ethan, who also knows a lot about what's going on with all his great background, and Ted come every week. And Melanie, we're so thrilled that you are here this week. So take it away, William.
Okay. Thank you, Peggy. So today I'm going to bring attention to the chat immediately. You'll see a link. It is a secured link. It's a landing page. Normally, I create a PDF, and it's a very, PowerPoint-driven idea, a visual. But today, I said to myself, and it's very important. Today, you're going to hear about something you either do know something about, or you've never heard about it. And if you haven't, it's hard to take it all in one shot and say, oh, I know that just as much as William. So I created the landing page so all of you can go back to it later tonight, tomorrow, next week, and you have your own password. It's 70, that's a zero, by the way, 2S small and large P for plan. And S, by the way, means strategy, not savings or Steiner. So you'll be able to follow along here. Now I'm going to share my screen. So again, depending on how big the visual is, you can just go on your own landing page and follow along. But the key is that I don't want you to feel pressured to try to listen and learn every detail, because it didn't take me, but it took me more than years to become someone who with this type of knowledge. It did not happen in 6 months. Trust me. Okay, so what we're going to do is I'm going to share screen. I'm going to open up this page, and let's see if I can do this pretty easily. Let's see. Give me 1 second. Let me open this up. Let's see. Okay. Now, again, I'm not a perfect Zoom guy, but I learned pretty quick. There we go. Share. And just let me know if you can see that. And again, what you see on this screen, you'll be able to see on your own screen. Okay. Again, most of you have, you're probably all on desktops, which is the best way to watch this version because it's the type is bigger for people like me at 62. I love larger screens. So I am very hard to with a smartphone, trust me. So today's title, Unlocking the Power of 702S Plan. Now, this is truly a wealth building strategy for real estate investors. In fact, for all investors, for anyone, you don't have to be a millionaire to have a 702S plan. I will tell you, the Rothschild family has had them for decades, and they're a banking family. And you would think, well, they've got to know everything and all the right things to do. Well, they do, but they've been doing it for such a long time. If you Google Rothschild and cash accumulation life insurance contracts, you can read the story. It's not something we made up today. It's been around for a long, long time. The idea was something to do with, actually, it was originally in the first 1900s. And it was so orphans would not be left with nothing. And that this was something done a long time ago. So who has done this type of planning? Ray Kroc, Rothschild family, Walt Disney. I mean, I can go on and on with the people. And I just forgot the famous football player, and I'm sure you know who they are. Tom Brady. Now, we're on YouTube, so I've got to be very careful what I say here. But our back office completed his contracts. I believe there were 12 of them. It's one of the most highest insured United States citizens on planet Earth. Obviously, he knew this was not about health insurance and life insurance. This was about cash accumulation. The longer he lives, the more compounds. And when he needs some cash to do investment or do whatever he wishes, he can do it on his terms. So the 702S plan offers a tax advantage alternative with greater long-term growth potential and flexibility. And today, flexibility is very important. If I wanted for some sort of investment in real estate, which is primarily why most everyone is here, you should be able to access this money and be able to dive into your investment because this is something you know very well. My name is William Steiner. I'm the founder and the chief strategist of the 702S plan. So I'm going to scroll down a little further. And the next part of this will be unlock tax-free capital for real estate growth. So here we're going to discuss a few of those points and how important it is to be able to grow your real estate and utilize this as a tool as well. So maximize your real estate portfolio without relying on banks, risking your principal. Today, you know, we don't have to say or emphasize enough how volatile the markets are. I mean, all I have to do is just watch the news and, you know, you and I and Peggy and all of us, we don't control the markets. There are a few people who have great influence, like Warren Buffett and people like that. But at the end of the day, one thing could move a market to the point where it's not in our favor, and that's not very good for us. So this is something that keeps that control in your pocket, in your ability, because at the end of the day, we work hard and we want to make sure our money is protected. The 702S plan, and by the way, risking your principal or even triggering taxes. Again, putting more money in your pocket, giving you more ability to purchase and develop your real estate, okay? 702S plan was created by myself and offers a secure tax advantage solution for high net worth investors who want full control over their capital now and for generations to come. A smarter wealth strategy for investors seeking liquidity, protection, and legacy. So in today's session, we're going to discuss how to create tax-free growth and access your capital on your terms. Why the 702S plan outperforms the 401k. We're just going to dive in that a little because many of you might have some of these savings plans that you utilize for real estate. And again, you should know by comparison what else is in the market. IRAs or mutual funds. How to preserve your principal from market volatility, which we just discussed. We have never, in my lifetime, ever seen the markets with such volatility. We've seen markets. And this could turn into a 3-hour conversation, but we're going to keep it real focused. Volatility is something we know about, and we've seen it happen in a day, normally a day, or maybe 2 weeks later, another jolt. But that's not what we're looking at today. We're looking at a daily, hourly movement of volatility that we've never seen before. And investors have a lot to be, concerned about. Obviously, those who aren't going to touch their investments for 40 years, well, we don't have to worry much about that. But at the end of the day, we need to worry about what's happening today and to protect our hard-earned money and our investments. So, and I know Peggy is a firm believer in that. So once again, how we create tax-free growth and access your capital on your terms, very important. Why the 702S plan outperforms the 401k and the other savings plans, how to preserve your principal from market volatility, strategies to leverage your capital for construction, development, and equity deals, and a real estate case study that I put together for a particular client. And by the way, I used a $1 million annual formula. That's just an example. You can do much less. In fact, you can do more. At the end of the day, these contracts are very flexible and they're based on what you want, what you're trying to create, not what the insurance company wants. I work for the customer, for the investor. I do not work for the carrier. I'm appointed by them. I'm licensed, I'm trained. But at the end of the day, I work for the customer. So my job is to help you understand how this works and how you can put it to work to improve your real estate portfolio. Okay, so let's go to the next part where we have part of the investor challenges that we solve. Everybody has challenges and they might say they're problems, but at the end of the day, it's a learning lesson. Once we learn it, we get past it and we become stronger and more brilliant from these so-called challenges. Real estate is powerful, but not always illiquid. Traditional accounts are flexible or inflexible, and you can face rising interest rates and tighter lending, which is something that we may be encountering more. And again, Peggy and many of you are experts in the real estate market, so you know that lending is very, very important on your terms at your time. Not necessarily doesn't happen that way. Delays in funding construction or having be able to an acquisition, penalties and taxes when accessing capital, and missed opportunities due to liquidity gaps. The 702S plan solves this with tax-free access and no market risk and total control. So let's now move quickly. Actually, before we go any further, I'm going to ask, has anyone either raise a hand or say yes on the chat? Has any of you learned or heard about creating tax-free and staying away from the market with using life insurance, cash accumulation, life insurance contracts? Becky is one of them. Okay. And Ted, okay, all are okay. Because I remember seeing Ted, so I want to make sure that if you do, I hope that you'll hear some things maybe you haven't heard before. Again, like watching a movie 20 times or 5 times. The movie looks a little different on the 5th time because you were able to see something you didn't see the first 4 times. So I'm hoping now we're going to bring out some of those things that you haven't seen or heard before. So what makes the 702S plan different? One is tax-free accumulation and distribution. That's because of an IRS code 7702. You can look that up. Again, you're going to come back to this landing page at any time you wish. So there are lots of ways to learn this, but go steady and ask yourself, oh, this is something important, Google it, or you can always send me an email. I'll be happy to answer it. No RMDs, capital gains, or dividend taxes. Creditor protection, very important. Estate tax benefits. Private, portable, and confidential. Private, portable, confidential means that it is not like a 401k where you're in the system. Here, this is a private contract. Portable means that you could take that contract or that insurance policy and you could be working for someone and then bring it along throughout your whole life, and you can negotiate and speak to your boss and say, hey, I've got a 702S plan. I'd like to see if maybe you might want to fund it at 6% like others and so on. But again, it's portable. That doesn't mean when you leave a company that it stops. 401k, that's a problem. So with this, you can take it with you wherever you go. And confidential, obviously it's yours, not anyone else's. Locked in annual gains and principal safety. So I'm going to hit on this locked in gains. So in 2008, we experienced a very difficult moment in trading in stocks, and the market went down and just at about 40%, if I remember, about 39%. Now, so if you had an investment the day before $1 million, the next day, let's say you had almost $600,000, but that was completely not in your control. With this type of contract and the security or the protection of that zero floor, your principal is safe, that when that market moves down that day, that week, that month, you'll never, or even a year, you'll never lose $1 in this contract. Not at least the ones that I create, okay? And at the end of the day, nobody wants to lose their money and no one can control the stock market. So if you can do something to avoid that loss or that volatility, I believe that's important to you. I realize the house could be worth $1 million today. The market shifts down hard, it would lose value, but then come back up again. But instead of letting it go down and come back up again, how about if it never went down? So then when it went back up again, you took all that gain. So in these contracts, there are never losses. So when the market goes down, it stops, okay? And then when it picks back up, it starts to move up again. But you take all that win. You don't have to wait for it to come back, all right? All right, so someone was calling me. I'm sorry for that distraction. So let's talk about, or let's look at what a 401k does against or comparison to a 701k.
Okay, before you go, you said
Yeah.
the RMD, and everyone might not know that is called a required minimum distribution. That if you're in a traditional 401k or IRA, you must take a certain amount of money each year based on what you have and how old you are and what you have in the account. So that's a required minimum distribution.
Yes,
Thank
and I
you.
should have pointed that out. Thank you, Peggy. I
Uh-huh.
believe that age is 73, by the way. And at the end of the day, yes, you're required, even if you don't want it. Today, over the next 30 years, it will be the largest transfer of wealth that the United States has ever seen. And it's called the Great Wealth Transfer. At the end of the day, there are a lot of people, there are children, children in their 40s and 50s, say, Dad, I don't want all that money right now. They're going to push me into a higher tax bracket. That'll be a burden to me. But at the end of the day, they have to take that distribution or be penalized. So in these plans, you can take money if you wish, not take it whenever you want it, whenever you want it, or never take it and leave it as a inheritance. So the point is, it's in your terms to your best benefit to be able to have full control. And thank you, Peggy, for bringing that to the point. So I don't want to spend a lot of time going through this list, but I just want to share with you, when you have time, just look down and you can see there are a lot of no's on the 401k and a lot of yeses to the 702s plan. So if you want a lifetime distribution or unlimited or in this case unlimited contributions in a 401k, you can only put so much in a 702s plan. You can put,
Unless it's a 401k Roth.
right, in all these plans. Again, I'm not a 401 expert, but I know enough to tell you that I believe that limitation is about 22,000 this year, pretty close to it. Maybe it's 23. But if you're really building wealth, it's hard to do it at $22,000 a year. And again, if you're subject to market volatility, that could drop when the market goes down. People have really been hurt the last few weeks, and they're going to be hurt more with a 401k. So anyone that wants to keep their money safe, you want to make sure wherever you put that principle, that in the market, in the event a market goes down, that your account value doesn't go down or you're not losing money. That's the key. There are many other structures. This is one of them, but that's an important thing. I believe Warren Buffett said, you want to put money somewhere where you can't lose it. So at the end of the day, it's wise information. So market volatility, obviously, that is something that is very important. So access to distribution, you have to be 59 and a half. After 1 year with 702s plan, you can access your money. You have living benefits. Obviously, the 401k doesn't have living benefits. When it comes to income tax, this is I want to stay on this really very important part. When you take distribution of a 401k, and if you took 10% and you got taxed, and the market shifted once or twice in the 10 years, you may survive about a 9 to 11 year lifetime distribution of your retirement. But that's not how long you're going to live. You're going to live longer and you're going to be out of money. And that's what most people are concerned about, is living too long. And not that it's a bad thing, but living too long without money is not a good thing. They don't want to be dependent on their children. So again, we're going to go over these highlights, and I want to share with you a few important references of how this can go to work for you. But these are just little bullet points that I want you to realize that you should go back and read, because these are factual. None of this is opinion. These are factual. Okay. Okay, so we're going to scroll down. This just explained that the 401k was introduced in 1978. It went live in 80. It's been available for 45 years. My plan has been available since 2023. We just finished up a case actually in the last 2 days for a woman, 65 years of age, retiring, who want to retire, who's in real estate. Actually, Peggy, I believe you know who she is. And she said, William, I need this. And if you can achieve me that, I would be very happy. Well, I was able to achieve that, and her plan started yesterday, so she's very happy. And regardless what the market did last week or next month or next year, she will have growth, and you will see this in actual historical form in a moment. This is the next thing we're going to talk about, because again, when you're in your 60s and 70s and you're not working, I'm not saying you're an investor, but you're not working, the last thing you can't afford is to lose money. And when you're an investor, no investor wants to lose money, not that I know about. So that's why they have Peggy to help. So let's look at this case study. So here is a $5 million capital funding for a 702S plan. And some of these key reasons why would you want to adopt this type of strategy if you're in the real estate business. So one is, this would cover, for bridge funding, it would cover short-term gaps between purchase and permanent financing, okay? All you have to do is say, I need $100,000 for a deposit, or $500,000, whatever that amount of money you have liquidity in your contract, sign a piece of paper, it's one form, they send you the money back to where you fund it, which would be your bank account, and then you could proceed, and you don't need to worry about the bank. Construction and renovation costs. So maybe this kind of money, you don't need $300,000. Maybe you only need $50,000 quickly for a house to finance ground up builds or value added projects. Number 3, portfolio expansion. So to acquire multiple properties simultaneously, you can have that ability by using this plan. And again, Peggy, you are an expert, or you have such great knowledge about real estate. But to be able to acquire multiple properties, that's a lot of work at a bank, if I'm correct, to borrow money. Am I correct?
Yeah, but we work with passive investors, so you can invest money passively. You don't have to do any of the work.
Yep, that's correct. Earnest money in escrow, obviously having that available is very important. Again, not have to go back to the bank or go borrow from someone. Avoid traditional lending delays. So bypass slow bank process and access flexible capital fast. Last, opportunity cost, which is not to avoid any missing out of a high return deal or transaction due to lack of liquidity. These plans give you liquidity. And if you have $75,000 liquidity and you need it now, you don't need a permission slip. You don't need a letter. You don't have to write out why. And, trust me, I know I'm not going to lose the money. At the end of the day, the money is insured because it's coming out of your liquidity. Okay. So you don't need to request with a nice letter. It's your money. It's your contract. And if you ever choose to bring it back, pull it back in like a line of credit, you can do so. If you're at a certain time in your life, you don't want to do that. You just want to keep investing with that money, you can. Okay. All right.
Okay.
So let's,
yeah. Can we start talking about that?
Yeah. Yep. I think this is where we're going to talk about the investment itself, Peggy.
Well, we want to talk about how you could use the money.
Okay. Yep. So To give you an example, or maybe Peggy,
Just
what would
gave
be
us an
your idea?
example, but how easy is it to borrow against your account? So let's say I have $500,000 in my account. When I opened that account, did I have to put $500,000 in so that I could borrow $500,000 back?
In the first year, most of the liquidity, let's say about 80% of it normally is available. Why?
I could
Because there's
borrow 400,000 against the
yeah,
100,000 policy. So now I have $400,000 I could use to work in construction or be a passive investor or an active investor if I wanted to be active. So I
sure.
have that money available. So how do you educate the policyholder on how to use that money to stay ahead of inflation? Because what kind of, I know you're going to show us in this next slide, but what kind of return am I getting on my $500,000, which is
Right,
coming off of the stock market?
right.
And how is that growing? And am I going to be able to borrow against whatever that growth is?
Yep. So the answer is yes. And what has been the
Yes, yes, and yes.
yes, yes, and yes. Yes,
Okay,
and yes.
good.
So first, if you look here or you're scrolling down on your page, you'll see a red dot and you'll see above that 11.35. So in the last 20 years, that's the historical average of return of this particular index, which is Morgan Stanley. We don't have to be experts at indexes and banks, but we just need to understand who is the institution, what is their basic historical averages, because obviously we want to see. And if the year is negative, then you would get a small 25 basis points. Again, you're never going to lose money, but if in a negative year, it will be flat plus a small amount, which is I call it a gift, but it's just a crediting policy of a carrier. They give you something as a customer.
So
But
what
you
do they give you as a small token?
a
Like
25,
that
yeah,
five
yeah,
percent. I don't know what 25 points is.
okay,
I know what
25
I know what
basis.
a percentage of the
Right,
dollar is, though. Am I
right.
getting 5% or am I getting 10% or
Yeah, when the market index goes below zero, goes negative, you would be given a 25 basis points, which is one quarter of 25 basis points. I hope that means a quarter of a point. So if 1 point is 1%, a quarter of a point is 25 basis points.
okay, thank you.
Yeah, and that's banking, and I don't mean to make it sound complicated, but that's the way we say it, 25 basis points. So if you look at some of these years, 24%, 16, 13, 23, 15, 33, 2017 was a very good year. 2019, 2020, 23%, 21, 17. So again, when you average all this out, you're looking at 11.35%. 11% on average over the last 20 years is a very good return. And I remind you, this is tax-free. So to accomplish 11%, if you were taxed, I guess you would be looking at around 25. So let's say you'd be looking at 16 or 17%.
Okay, so I've got my $500,000 and then I can borrow 400,000 and my money's working in there, but I could take it out and put it into a 20% real estate return.
Yep.
Okay. And that takes, let's just say 5 years. So I'm making 20%. So I just got 100% back on my 400,000. I now have 800,000.
Right.
Do I get to put the 400,000 of capital gain in the
Yep.
policy?
Yeah.
So I
And
can return that and I have to pay back the company that lent me the 400,000, correct? Because I'm
well,
taking the
not
out of
necessarily. Not necessarily. So you borrow 400,000.
against.
It's from your own liquidity now, not from some other entity. You're borrowing it from your own account value.
Right. So, but I'm not taking the money out of my account.
Not out of the value of the account, you're taking out of, you're
I'm
borrowing.
borrowing it against the
Yeah,
account.
yes,
So the
exactly.
security for the insurance company is what
Insurance contract.
is the whole money still in there, but I'm
Yes, correct.
borrowing against it. So I'm paying, let's say 5% to
Correct.
borrow. I'm
Get five
putting in
percent.
4% to borrow. I'm putting in a 20% annual return. So
Yep,
that means I'm making 16% over what the company's charging me. So when I get my 800,000 back, I put the 400 back.
right,
And then the other 400, I'm going to have a tax deduction
right,
of the interest I had to pay, correct?
correct,
For the 5 years, because I don't have to pay them back until I get my money back. So I don't have
right.
any payments for 5 years on $400,000. How good is that? Oh my God, that's
Very good.
incredible. Okay, so
Yes,
now I'm going to pay the 400, whatever that is. I'm not working on my calculator.
it's okay.
Uh, 16,000 a year. So whatever I owe. And then I now have to pay capital gains on, let's say there's 300,000 left. I have to pay capital gains on that 300,000, but I get to put that 300,000 back in and it's going to continue to earn. So I doubled
Correct,
it outside of that. Plus I compounded what was in there for 5 years. So
correct.
now I've got what, almost $2 or $3 million, right?
Yep. The
What could
key
be
to
better
this,
than that?
I'd like to think this is the best safe means of building wealth, because again, there's no stock market volatility. That's the most important thing, because anything to do with investment in today's world normally is related to the stock market. So when the market goes down, it does affect real estate value. Now it comes back up, but at the end of the day, if you can avoid market volatility, it's to your favor. That's
Sure.
all. And I'm going to say one thing, because I really want this to head home. If you had $1 million in your account value, and you took out a half a million, and you put that into Peggy's, real estate ideas, and you generated 20%, and you also generated 20% from the account value working every year, then you're looking at 40%. And that is magic. Again, as long as you're borrowing money from this contract and you're putting it to work, and meanwhile, that's still generating at the same amount of account value, going up 1 million, 1, 2, 1, 5, then that for me, I think it's got to be one of a major piece of the puzzle to help a real estate person to be able to access and compound and build their wealth from something that just keeps compounding and building. And I want to ask if everyone understands that, because a lot of people get confused. Do you realize that you can have in one hand your bucket of account value of $1 million? You can take out 800,000, $500,000, and put that to work. It's a rate of 5% to borrow it, but you can take money and generate profit in the real estate business, but that never ever reduce the account value in your insurance contract. Do you fully understand that? If you do, just raise your hand. I want to make sure everyone understands that. Yeah, not everyone does. Christina, I know it's confusing. It's almost like, well, that's not possible. But what happens is, in an insurance contract, in this plan, there are three buckets: account value, liquidity, and insurance.
I
So,
passed the insurance test. I was an insurance agent. I'm very aware of what you're talking about. Thanks.
okay, I didn't see a hand. My apologies.
Oh, yeah, it was just the tops of her fingers showing.
Okay, I didn't see it. So it's, to me, that's very important to understand how it works. Again, if you don't know, it's confusing, then people start saying, no, it can't happen. But at every day, people who have this type of plan or cash accumulation life insurance contracts are borrowing their money to build their wealth more. So I'm going to show this particular plan, which you would see in tabular detail. And here, again, I'm not going to dive too deep into this. I think it'd make more sense for you to look at it quietly and take your time. But you can see the cash plan for 5 years with this $1 million a year, and that would count up to about $5 million for the 5th year. You have an insurance component, and somebody would say, "Well, William, I put $1 million in, have account value of 837, have a liquidity of 500, and $13 million with insurance." Well, in the event something should happen, to be able to have $13 million worth of protection, both in either a living situation or in case of something happened prematurely, obviously that $1 million would allow you to leave quite an estate, your family, taxes, your business. This also could be used for a business relationship with partners, which is a buy-sell agreement. That's something that you could always ask me about, and we can discuss at another time.
Well,
But
let me ask you a question on this. My understanding is that if you have a life insurance policy and if I have a life insurance policy and I buy it on myself, it becomes part of my estate and is taxable. Whereas if you, William, bought my policy on me, it would not be part of my estate. So if
Okay.
it becomes part of my estate, it then becomes taxable because it put me into a higher level. Was I
No,
clear on that?
no, I'll make it a little crisper.
Oh,
One
thank you.
is this life insurance contract, the inheritance or the estate benefit or the death benefit is tax-free. Okay. In this, it is. So whether, Peggy, you're actually funding it, or let's say we're partners, I did it for you out of a buy-sell agreement. At the end of the day, this is after tax dollars. So if this was an executive bonus and I paid the plan, but I also paid the taxes because it was income, anything that goes into the contract and grows thereafter is all tax-free. So whether you're borrowing it, you have a living, an injury or something, and you have living benefits, or you leave it as an estate and it goes to your estate, at the end of the day, it is all tax-free. And the word estate, there's beneficiaries. I know all of you know what that would mean in an insurance contract. That beneficiary normally is the estate, normally, or it could be just two children or whatever. But depending on wealthy people, normally leave it to an estate. And the estate has taxes and other things it's responsible for, like the Rothschild family, great example. It's not, oh, Johnny's going to get the death benefit. No, the estate will get the benefit. That's normally how that's structured.
Well, then does that make it taxable? Because
And
say it's got $13 million and they reduce that to 5 million, and anything over 5 million you owe taxes on.
no, I can assure you, Peggy, in this plan, in this contract, that $13 million, again, if someone should pass away that quickly, it's
Is
all
tax-free.
tax-free. Yeah. Yep.
Okay.
Okay. So again, wealthy people use this for estate planning because yes, the death benefit, the money goes to the estate. And then it's, their financial people pay taxes or do whatever it is that the estate has decided to do. But if you're one person, you have a child and you get it and you get one on yourself. And then when you pass, you leave it to your child. That's a common thing for small families. But when you're a wealthy family, normally the death benefit is provided to the estate.
Okay. Does anybody have any questions? I was bogarting all those questions, so.
Yep.
From
Okay.
Melanie. Oh, Melanie put something in the chat. Let me double check.
Okay. And again, these are a lot of numbers to look at. That's why you should look at them slowly. I could discuss this for 20 minutes and I don't want to overwhelm you.
Okay, is there a way to transfer a currently overfunded insurance plan to this? Is there a way to move ESA for children to this plan?
Okay. So any existing contract that has cash accumulation can be moved to another contract. They call that a 1035. I forgot the code for the mortgage industry, for the real estate industry, but when you transfer one thing to another, that's another number. What number is that, Peggy? Just when
What?
like in insurance contracts, when you move one to the other, it's called a 1035 exchange.
1031,
Okay.
real estate to real estate is 1031.
Okay, 1031. So ours is 1035. And
Yeah,
so, yeah.
company.
Now, when someone comes to me and says, "Oh, I have an insurance contract. I'd like, you seem very knowledgeable, and I want to do it your way. Let's do it today." I'm more than happy to say yes, but at the end of the day, we ask questions. How long have you had the policy? Are they surrender values? Does it make sense to do it so quickly? So, you really need to speak to someone who's more conscious about what's best for the customer than what's best for a salesman, because at the end of the day, you need to make a conscious decision based on true information that's factual. And I suspect Christina knows all about that. She has experience in insurance. Insurance is, sold by many, many people. Not everyone knows, the true details of why someone should do something. And we have that in our hearts. We certainly want to help you, and we want to make sure you have the best benefit and proven benefit, that if you want to move one contract to another, that it makes sense, then we can improve the situation. That's very important. Any other questions, Peggy, on that?
Yes. Come to think of it, I wanted to know in your weekly, so you say you have weekly tips and training. So,
Yep.
so what do you talk about in your weekly tips and training?
Well, it depends on the questions normally from the customer, but we go from anywhere from what we can do for helping of children, how to do the funding, can employees help with funding employees of these type of this type of plan? The answer is yes. In this particular tabular detail, there's a lot of questions because people say, well, this goes to zero and this is less than that one and that's one is less than that. It's because these are formulas and these are projections. If you look to the far right, it says 7.20 EOY, that's end of year. Well, William, if this index does 11.35 on average, and this is illustrating at 7.20, isn't that much less? Yes, and the insurance industry wants it that way because we don't want to overpromise people. We want to give a very conservative approach and a conservative number. So when they see these numbers are actually very modest. And when they see the difference between what these modest numbers and what the potential on historical averages, especially with the Morgan Stanley index, real estate people or investors are very, very intrigued on knowing more about this and seeing how it would work for them. That's why I'm a big promoter on someone making an appointment with me and having as many questions as they choose so I can answer them. And again, education is so very important. I wish we could teach our children at a young age more about planning and financial decisions and so on.
This book will do it. This will teach them. I feel the same way. That's why I wrote the book. So, but let me ask you, I didn't hear how you instruct these people about how to borrow against the account and invest it in other ways.
Okay.
Invest, not go buy a new car, not put a down payment on their house they're going to live in, but put a down payment on a 10-unit apartment building.
Right.
Or be a passive investor and make 20% returns.
Right.
So when do you have those, or do you need someone, me or different people come on to educate them?
Yeah, that's not the average every week conversation, but many of the people that come to me are business owners and in their minds know what they want to invest in. But I always share with them, look, this is your money. You can invest in anything you want.
Yeah, it's a savings account.
Yeah, exactly. Crypto, we have not mentioned one word about crypto, and I don't know much about crypto, but I'll tell you that's becoming more popular and gaining ground. And somebody might say, hey, let me put a few dollars there. The whole point is this: it's your money. You can choose to invest it wisely, but we guide our customers to make sure they clearly understand how to do it, and that it's their decision how to invest. We don't give investment advice, but if I had to give advice, it would be simple. I believe in real estate. I believe it's something that will always be strong. Sometimes you have to wait sometimes where it goes down a little, but it always goes back up again, like a ride, I guess, so to speak, a financial uptick over 10 or 20 years. We had such a run on real estate, but at the end of the day, I find that being able to borrow this and use it for real estate is one of the best means of using this type of borrowed money. Because again, if you're borrowing at 5% and you can maybe have a 10 or 20% increase per year, then you're making the difference So if you went up 20% and you paid 5, you got 15% in your pocket. Remember, the upside of this contract is tax-free.
Yeah,
Money,
that's right.
yeah, the money that you create from other contracts, not knowing all those complexities of how you can utilize tax-free elements in your real estate, because I know they're out there, that you need to speak to professionals like you.
Yeah, so the other thing that's super important that nobody ever talks about is inflation. And being in the policy helps because it compounds. So
Right.
maybe you could stay ahead. Maybe. Truly, you need to be getting into double-digit returns or very close to that to be able to stay ahead. I mean, I'm not political, but I foresee we are going into a recession with all the millions of people who have been put out of a job in the last several months. That all that does is hurt everybody, everybody,
Yeah,
everybody, everybody. So if you could have that money working for you to stay ahead, I can't make a determination. I wish I had a crystal ball that told me the truth about what was going to happen. We
right.
we have to do everything we can to protect ourselves. We have to protect ourselves.
Agreed.
So what are
Not,
the
not,
set? Oh, so Chris is asking, what are the setups and annual fees? Are there any?
okay. So if you're an individual putting in, funding your own plan, the only fees are internal fees of the policy, and insurance has that, how do you say, breakout. And when I do an individual plan, clients normally will ask for that. We provide it so they know exactly how much the costs are. I will give you this, because I've run many of these. The average cost of managed money today is about 1%. Okay, so whatever they're managing, they will charge you 1%. It's a standard. When we do our numbers, depending on whether it's a child or an older person, an adult, we range from anywhere between 0.37, and again, that's a fraction of one, but we're normally about half or 60% less. And again, depending on every case is different than the cost of managed money. Managed money is every year for the lifetime of the person. Our fees go down as the years go forward. So fees in accounting in managed money go up, ours goes down. It's complete opposite. So again, dollars and cents, we run that report. Every person knows what we are compensated for these contracts. And again, the cost is much less than managed money. And with managed money, obviously they can't give you guarantees that market won't take away. We give you the guarantee, and that guarantee is a zero floor. That's not something that I say, it's what the carrier does.
So what's the fee based on? Is it based on the gross you have?
Nope, no, it's based on contributions, actually, not on the growth.
It's not based on the growth. On
Yeah,
the, so if I'm paying $200 a month, is that my growth?
no, no, your contribution is $200 a month or $2,400 a year.
But the growth is on what it made, right? On the
Yeah,
compound?
no, it's based on contributions. And again, what I'll do, Peggy, if you like, I can run a simulation for you so you can clearly see how that would what that means, potentially in your
So,
situation.
so I start off paying like a 0.5%, and then I grow, let's say I put 500,000 in, and now after 10 years, I've got, we'll just say several million. Is my fee still at 5%? Or
They're
so
going
the
down.
fee went down, but the amount they get will be more because the account has grown.
Right. No, managed money, the more it builds, the more money you pay, because it's charged at 1%.
We're talking about what your
705.
company does,
Yeah,
not what
yeah,
somebody
yeah.
else is doing.
Right. In our plan, the costs go down, and you will see that when I do a plan.
I'm paying a 0.5 point to begin with, and 10 years later, my account's tripled, but the fee I'm charged is dropped.
Keep
But they
dropping.
make more because the account is more.
Correct.
Okay,
Correct.
just double check it because Chris is asking
Yeah.
how that works. So did
One
that
is for,
answer your
yeah,
question, Chris? Okay, good. Just wanted to make sure. Got to make sure everybody gets taken care of and their questions get answered.
right.
So I'm
Yep.
asking because Melanie said she was in an ESA and I don't know what an ESA means. Initials always drive me crazy.
Yeah, I'm not familiar with ESA. Uh, Christina, do you know what ESA stands for?
I have a question.
Yeah, go ahead.
Maybe
I
Ted
think
knows.
ESA is education savings account.
Oh, okay.
Okay.
Oh, that's very different than a life insurance policy. So Christina's got a question and Ted's got a question.
I was just curious about 7702. What is a 7702?
7702
code.
is a tax code rule, and it was created because the Congress created this law about cash accumulation life insurance contracts, and the IRS steps in to make sure it's compliant. So if you're not compliant, it's not a bad deal. It's just that you have to pay tax when you take money out of the, for a loan. If you are compliant to the 7702S rule, then you can borrow that money tax-free. And all my clients have always been, and it's the only way I promote it, is tax-free.
Did that answer your question, Christina? Oh, I think you froze up.
So it's like a
Yep.
It's like what?
reception off
Say
today.
say it again. We didn't quite get
Yeah.
it.
Okay.
So
Not you, William. Christino. What
So
is
is it like a form that you fill out through the IRS? All right.
It's a rule, it's a code. So when you have a life insurance contract that is cash accumulation, not a life insurance like a term product, but a cash accumulation contract, when you take money out of that contract and you are compliant to that rule, you can do so tax-free. And you can Google 7702 S rule, IRS, and then you can get all the data. We have a PDF file that I'm happy to send you. So Peggy, if you send me, or I can send you that document, and you can send it to Christina, which is in full detail. That's the
So what
IRS.
I'm hearing is that the 7702 is just a code that is included in the paperwork when someone signs a contract.
Yeah, so 7702 is IRS code, and the code tells you how you could run the non-taxable or tax-free product. So if you want to know exactly how that works, then read the code.
Yep.
So you can stay within it, or William will send a PDF that covers all of that.
Yep.
As he dumbed it down.
That was my question.
Thank you.
Yes, and Ted, you've got a question or a comment?
How much are these contracts influenced by medical underwriting?
They are influenced. So if we're talking about you, Ted, if you send me an email in confidence and just let me know a little about any health potential circumstances, then I can tell you if I could get a contract approved. Different carriers do offer different contracts for different circumstances, but I'll give you the worst case scenario. Let's say that you had a heart attack yesterday and you obviously wouldn't be able to get a contract today, but you're an investor. Two people you can choose. One, you can have a partner, someone who you trust, and they can be the insured. You own the contract, fund the contract, and be the administrator of the contract. So you control all the money and everything. But you wouldn't directly be the insured. Or if you have a child or a sibling, again, that is in good health and could get approved, then we could do that as well. But if you have a partner, you can fund a contract, control everything, and he would be have the upside of the insurance component. But if anything should happen to you after that, Peggy, just to add to that, is that he could take money from the contract if he needed to pay medical bills or do anything to help himself medically if he needed it. So you don't have to, have the life insurance component or the living component to access the contract to say, oh, I need $40,000 to pay for medical bills. It's there for you. But again, if it's for you and only you, if you cannot be approved on the health part, then I could show you how to remedy that issue, which is very compliant and done all the time.
Does that answer your question, Ted? Or actually brings up more questions, but
Probably adds more questions, but for the time being, that's okay.
Yeah, well, it has to be on a per person
Yeah.
basis, so you can't just say how much is it. It all depends on what the history is. Like the history I have, probably I wouldn't be able to qualify. Yeah, I'm perfectly healthy, but all the crap the doctors say about you, uh, makes you look like you're on death's door.
You don't look very, you don't look like you're in death door.
I
Peggy.
know, but if
You're shining.
if you read what the doctors say, they have you on
Right.
death's doors.
Yeah. Yeah.
Just the
We're
way they
we're
write
all
it.
dying. It's just a question of when.
Yes.
But the amusing thing is that annuity tables always give you at least one more year.
Well,
Yeah, so we're at the top of the hour.
yep.
Any
And
last,
just a quick clarification question. You say the IRS code is 7702, but yet you called this plan as 702S.
Right. I created the name of the plan or branded it's a strategy
Oh,
from
okay.
from the IRS tax code because that's so prevalent. I mean, I just thought it was a perfect natural. And as long as I didn't call it the 7702S plan, and then of course the IRS would be calling me, but I'm certainly free to create a strategy. And at the end of the day, it's because of that tax code that makes this so attractive.
great.
Thank you.
Thank you, Marcy, very much for that question. And I love the flowers back there. Thank you very much, William, for being here. It's been great. What a great presentation. Thank you for
Right.
answering all of our questions. And I hope you'll come back again and we'll talk about some other things further and educate people more and more.
Thank you, Peggy. Thank you, everyone. Enjoy the reading after today. You'll go back and learn more. Every time you read it once or twice, you'll learn a few more things. So thank you so much. Thank you.
Welcome.